Right now, it feels like the entire global market is making one giant bet on a single outcome, while the real economies on the ground in the US, Europe, and Asia are telling totally different stories. That disconnect, that's the Great Divergence. And in the next minutes, we're going to break it down, fast, clearly, and with the key risks you actually need to watch. Stay tuned. Our explainer starts now. And if you want the deeper context, the Why This Matters layer behind the headlines, listen to our latest weekly market update episode, now playing on our channel. Hit play right after this, and you'll have the full roadmap for the week ahead.
Right now, it feels like the entire global market is making one giant bet on a single outcome. But here's the thing. If you actually look at the economies on the ground, in America, Europe, Asia, they're all telling completely different and often contradictory stories. It's a huge disconnect. This is the Great Divergence, and we are going to break it all down.
So here's how we're going to tackle this. First, we'll look at what exactly this one big bet is that has markets so excited. Then we'll dig into the very confusing clues coming out of the US. We'll jump over to Europe's inflation surprise, and then get into the really wild stuff happening in Asia, where economies are moving in opposite directions. And we'll wrap it all up with 5 key risks to watch for in the week ahead.
Okay, so what is this one powerful hope that's got everyone so bullish? Well, it all boils down to one thing, the US Federal Reserve. The expectation is that the most powerful central bank in the world is about to change course. And, because the US dollar is basically the engine of global finance, when the Fed makes a move, the entire world feels it.
And this really is the million-dollar question, isn't it? I mean, with the global economy pulling in all these different directions, how have investors decided that this one thing, the Fed pivoting, is more important than everything else? Well, it's all about the belief that the Fed is not only done hiking rates, but that it's actually ready to start cutting them.
The logic here is pretty straightforward. Investors are looking at signs of a cooling U.S. economy, and they're not seeing it as bad news. No, they're seeing it as great news. The thinking goes that the Fed has done its job fighting inflation, and now it has a green light to cut interest rates. And of course, lower rates would just pour fuel on the market fire. It's exactly why we've seen U.S. stocks ticking higher lately.
But, and this is a big but, this is where the story starts to get a lot more complicated. Because when you actually look under the hood of the US economy, the picture is anything but simple. What you find is this weird mix of both weakness and, surprising strength.
On the one hand, you've got data that absolutely points to a slowdown. A key report showed the private sector actually lost 32,000 jobs in November. I mean, that's the biggest drop we've seen since early last year, and it's a really clear signal that the labor market is softening. This right here, this is Exhibit A for anyone arguing for rate cuts. But then, literally on the same day, you get this piece of data. The services sector, which remember is the real engine of the US economy, just posted its strongest activity reading since February. So which is it? Is the economy cracking or is it resilient? The data is pointing in both directions at the exact same time.
Now, the really interesting thing here is the trend. Yeah, core PCE inflation, that's the one the Fed watches most closely. It's still at 2.8%, which is above their 2% target. But the critical part is that it's the lowest it's been since early 2021. And look at that. It's been heading down for 4 straight months. That downward path is what's giving the market so much confidence.
Okay, let's hop across the Atlantic now, because Europe is really throwing a wrench into this nice, simple story of global easing. Just as the US is seeing inflation cool down, Europe just got a bit of an unwelcome surprise.
Just look at this. Headline inflation in the Eurozone actually ticked up in November. It came in hotter than all the analysts were expecting. And even though core inflation stayed put, that little upward tick is exactly what the European Central Bank does not want to see. It really complicates their job and probably means any rate cuts in Europe just got pushed even further down the road.
And if we look over at the UK, the story is more one of, let's say, cautious stability. The housing market there is surprisingly firm, and people are still applying for mortgages. But there are these big question marks hanging over everything, mostly around government policy and potential tax changes. So it's yet another distinct economic picture, totally different from both the US and the rest of Europe.
But if you want to see the most dramatic example of this global tug-of-war, we have to go to Asia. Because over there, the world's biggest economies aren't just taking slightly different paths. No, they are heading in completely opposite directions.
And this right here just perfectly illustrates the tension. The entire US market is obsessed with the idea of rate cuts. At the same time,
The Bank of Japan is openly talking about rate hikes. You've got two of the world's most important economic engines getting ready to hit the gas and the brakes at the exact same time.
And listen, this isn't just speculation. This is a direct quote from the governor of the Bank of Japan himself, Kazuo Ueda. These comments signaled a massive, historic shift away from decades of that ultra-easy money policy. It sent the yield on Japan's 10-year bonds spiking to a 16-year high. You can bet the market is taking this very, very seriously.
But here's the twist. Just as Japan's central bank is getting ready to tighten its belt, the Japanese consumer is pulling back hard. Household spending just saw its biggest year-over-year drop since January. So, how can the Bank of Japan really hike rates if its own consumers are already struggling? It's another major contradiction.
And then there's China, pulling on the global rope in yet another direction. Its huge manufacturing sector has been shrinking, that's what a reading below 50 means, for 8 straight months now. And its service sector just dipped into contraction for the first time this year. The only thing propping up its stock market is this kind of speculative frenzy around AI and chip stocks, and that's masking a really deep slowdown underneath.
So here's the bottom line. This level of global economic tension, it just isn't sustainable. Something's got to give. And this coming week brings a whole series of events that could finally force the issue one way or the other.
Okay, 5 things to watch. First, the Fed itself meets on Wednesday. Markets have priced in an 87% chance of a pivot to cuts. Anything else would be a huge shock. Second, more U.S. labor data. Will the job openings report confirm a slowdown? Third, keep an eye on any more signals from Japan. A surprise move there would be massive. Fourth, China's inflation data. It could confirm that deflation is setting in. And finally, any talk from the European Central Bank that inflation is too sticky could push their rate cuts even further out, maybe even into 2026.
So, this is what it all comes down to. You have the markets all in on this one, simple story of coordinated easing led by the US Fed. And then you have the messy reality of diverging, conflicting economic data from every single corner of the globe. So with all these central banks moving at different speeds, who's got it right? The optimistic markets or the complicated economy? The answer to that question is going to define the next chapter for all of us.
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.